Chapter 14, Market Liquidity. Section 5, Liquidity and Volatility. Liquidity and volatility often move in opposite directions because they measure different things. Liquidity is the market's ability to absorb trades, while volatility reflects how far and how fast prices move. So when there's plenty of depth, orders tend to create smaller price changes. Deep liquidity shows up as real buying and selling interest spread across several nearby price levels, not just at the best bid and ask. That depth gives the market room to absorb trades in smaller steps, which is why prices usually adjust more smoothly instead of jumping. Thin markets behave differently because there are fewer participants, smaller resting orders, and bigger gaps between available prices. In that setting, even a modest order can sweep through multiple levels and turn an ordinary trade into a sharp move. This matters most when markets get stressed. Bad news can bring a wave of urgent selling just as quote providers pull back, cancel orders, or widen spreads, and a market that felt normal a moment ago can suddenly become fragile. Once liquidity starts to thin, the problem can feed on itself. Bigger price swings make participants more cautious, they show less size or step away, and that drop in liquidity allows volatility to rise even further. Market makers can help keep prices stable by continuously posting bids and offers and standing ready to absorb some order flow. But that support depends on their willingness to keep showing size, and when they reduce quotes or back away, prices can gap much more easily. When liquidity dries up, the damage isn't just more volatility. Trading gets more expensive too because spreads widen, slippage increases, and poor execution can quietly eat into portfolio returns. Imagine a stock like Omega Robotics trading normally with a tight spread and decent depth. Then a negative rumor hits and a large sell order arrives. If the book is thin, the drop can be much sharper than the news alone would suggest, because there just aren't enough bids there to absorb the selling. Before placing a trade, it helps to look beyond the headline spread and ask how much real capacity the market has nearby. Check depth across several price levels, compare displayed size with recent volatility, and pay attention to warning signs like quote cancellations or sudden gaps. A lot of avoidable mistakes come from assuming liquidity will still be there when you need it. In thinner conditions, it helps to be careful with market orders, watch timing around the open, close, and news events, and remember that a tight spread alone does not guarantee a stable market.